Hey everybody, welcome back to the show. My name is Luke and this is the Option Bomb. And today we are going to be looking at Broadcom, ticker AVGO. We are going to be discussing their most recent earnings report, which was on June 3rd. The massive 14% drop, which is even accelerated now to the downside. And we're also going to be talking about a options trade that we could place based on how the chart looks as of today, which is June 11th. Broadcom beat earnings, right? They beat revenue. AI chip revenue exploded 143% year over year. And the stock still fell 14% in one day. Now, that's not bad luck. That is not the market being irrational. It's the market reminding everyone of one rule. The quarter does not matter nearly as much as the guidance. And if you didn't understand that before the Broadcom reported, right, you got wrecked. So today we're going to be breaking down exactly what happened to Broadcom, why the stock got crushed, and what the options market was telling us before, during, and after the report. Because guys, this will happen again. It'll be a different ticker, but it'll be the same setup. So here we go. And real quick, nothing in this video is financial advice. I am an educator, not a licensed financial advisor. Options carry serious risk, and this is for learning only. But let's get going into this. So Broadcom reported fiscal Q2 2026 results after the close on Wednesday, June 3rd, right? Going into the report, the stock had been on a monster run. The AI infrastructure trade was, I mean, look at Micron, right? Look at AMD, go look at the SMH. Everything was through the roof. And Broadcom was one of the biggest winners. And this wasn't just normal semiconductor hype, right? Broadcom makes custom AI chips, ASICs, for the largest hyperscalers in the world, right? And who are these people? Google, Meta, and others. So these are not retail chips. These aren't something me and you are going to go into Best Buy and be like, hey, I need one of these Broadcom chips so I can put it in my laptop. No, that is not what they make. These are custom multi-billion-dollar infrastructure contracts. So expectations for this earnings report were extremely high. And then the numbers came out. Revenue was expected at 22.13 billion. Broadcom reported 22.19. A beat, right? Non-GAAP EPS was expected at 239. Broadcom reported 244. They beat. AI chip revenue came in at 10.8 billion, up 143% year over year. That's not a miss, and that is not a weak report. It is a blowout number. And yet the next morning, the stock opened down about 14%. We closed near 479 and opened around 410. So more than $60 per share was erased overnight. And it didn't stop with Broadcom. Marvell dropped 16%. Micron dropped 13%. AMD and Intel were each down around 11%. Right, the SOXX, the semiconductor ETF, dropped about 2% just from Broadcom's gravity. The Nasdaq had its worst day since April of last year. One earnings report, one guidance number, and it was complete carnage. So why did this happen? Right? When we're talking about this type of report, this type of guidance, these types of expectations, right? We need to understand that it came down to one thing, and it was Q3 AI chip guidance. So Broadcom guided next quarter AI chip revenue at $16 billion. Wall Street was looking for $17.2 billion, which is a $1.2 billion gap. So not on the quarter they just reported, right? They beat those numbers, but it was on the next quarter. And that's the key. Broadcom did not blow up because it didn't execute in the previous quarter. It blew up because the future was not good enough to keep up with the price that the stock was trading at. And then they made it worse by not raising the full year AI chip outlook. Right? They kept the same language. In excess of 100 billion for fiscal 2027. Same as last quarter. No raise, no acceleration signal. No AI demand is even stronger than we thought moment. And that was the problem. The market had already priced in a beat. It had priced in strong AI revenue, and it had priced in momentum. What it wanted was a beat and a raise, like, hey, we did good, and we're going to do even better next quarter than we thought we were going to do. But instead, it got a beat and a hold. Now, this is not bad news. Broadcom's not going out of business. But when we are talking forward-looking stock prices, anything that doesn't meet those expectations, especially in the red hot AI chip sector, right? It can cause the price to drop. And Broadcom was priced for perfection, right? So a beat and hold trades like a miss. So here's the rule, guys. This is the part that retail traders, me and you, people that are trying to make a buck, we have to understand this. The market does not reward beating earnings. The market rewards beating forward guidance, especially in high growth tech, especially in the AI names, and especially in stocks trading at premium valuations. The backward looking quarter is almost old news by the time the report comes out. So what matters is what management says happens next. Because Wall Street's not just modeling what happened last quarter. They are modeling Q3, Q4, fiscal 27, margins, revenue acceleration, AI demand. And when guidance comes in below the model breaks. Price targets will come down, multiples compress, and every fund that owns the stock asks the same question. Why am I paying this price if growth is slower than expected? Then they sell. And they sell fast. And that's why the headlines can say Broadcom beats earnings and the stock still gets completely obliterated. Because the real question was never did Broadcom beat? The real question was did Broadcom beat enough to justify the valuation? And the answer this time was a resounding no. That's the lesson. A beat is not always bullish. A blowout earnings report is not always enough. And a stock can report great numbers and still get crushed if the market was pricing in something even better. So guys, the options market before earnings, right? We're going to talk about how this looked from the options side. Before every earnings trade, the first question is not, do I think the stock goes up or down? The first question is, what move is the options market already pricing? That is the expected move. And you get it by looking at the money straddle on the nearest weekly expiration after the report. Broadcom was trading around 479 before earnings. And let's say the market was implying roughly an 8% move. That puts the expected range around 441 on the downside and 517 on the upside. That's the field. The options market was basically saying, we expect Broadcom to finish somewhere in that range. So if you traded this report, you had to decide, do I think the move is bigger than expected? Do I have a directional view? Or do I think the event is overhyped? And those are three completely different trades. So guys, what we're going to do right now is we are going to hop over to the Broadcom chart and we are going to break down what we think after this post earnings release, what type of options trade we can put on this to make some money. And just full disclaimer, I have not gone out and looked at the chart yet. I'm going to pull it up, take you through my thought process, and see if we can find a trade to put on. All right, so I've got AVGO, Broadcom pulled up, and we can see this massive drop. We're up at 495, boom. We are already down at $375.23, and this is probably 8 days after the earnings release. You can see right here, we sliced through these last couple peaks right here, these swing highs, all the way back on October of 25, sitting at 375 bucks. So what I'm going to look for is, number one, let me pull up TastyTrade. I got AVGO, 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 Broadcom pulled up. We're going to be going about 45 days out. Let's just see what it looks like. Number one, though, IV rank is 36. So the implied volatility is still high enough for us to sell some premium. To order to buy a call or a put, if you have a directional bias, this is kind of high, right? You could still experience some IV crush, and even if it makes a move, you might not be able to make some money. So since the IV is high, 36, I'm going to be looking at selling some premium. If I open up July and pull the chart back up, I'm going to draw a Fibonacci because I like to combine all these different things. So I'm going to go Fibonacci from this swing low at 289 all the way up to 495. And look at this, guys. This thing fell almost to the 618 retracement at $368, almost to the nuts. Like, look at it, you can't get more perfect than that. So what I'm going to do is I'm going to look at this next level. I'm going to see what a 334 or even a 290 put will get me. And then I'm going to look at maybe 445 to 495 on the call side. Maybe we set up a strangle on this one. So if I put on my short strangle, we can go all the way down. We can go to 304. I mean, look at this. We can still get $2 out of this 480. So what is let's say what a 300 480 looks like. That's only a 7 delta on the upside call side and an 8 delta. Geez, we could even go 310. Let's go 310 470. Let's see what that looks like. So 310 470. I'm going to draw these lines just to get a good idea. 470, 310. It's way down here, right there. Guys, I kind of like the looks of this thing here, and I'll tell you why. Okay, so right after earnings, I really don't see Broadcom breaking out to new all-time highs. That's a long ways to go, and especially after that report, the traders and the big money market guys are going to be like, hey, you need to show us after this next earnings report that things are going back and accelerating again. So I don't think we're going to touch. Yeah, I mean, in this 470, this is above this gap up here at 466. So if anything, say it does rip to the upside, this is going to be some meaningful resistance here, all the way up at 470. Then to the downside, I mean, look at all this. Look at this box right here. Let me draw a box. Look at all of this. Damn it, come here. Why is this not working? This is my rectangle. Anyway, right here, you can see all of this. I don't know why my tools aren't working. This is going to be a heavy zone. Like all this activity in here is going to provide a lot of support and resistance in just this consolidation zone here. This was all the way from April 26th all the way back to December. This is 4 months of consolidation and sideways action. If it does get back in here, it's probably going to do the same type of thing. So I think we're pretty safe to the upside. I think this 310 is going to give us a nice spot of support. And this is a 4-hour chart. Let's just go out to the daily. I'm going to see what it looks like. Same type of thing. Look, I mean, this looks great. All this up here, all this room to the upside, this got way overheated. Down here, we're good. So I think the trade that I'm going to put on Broadcom post earnings, just to try and make some money, is a July 470 to the call, 310 put, strangle. I'm going to sell this, collect some premium, and I'm going to try and make between 25 and 50% and then get out. So guys, here's the entire Broadcom lesson, right? The market rewards guidance, not earnings. And a beat is not enough if the stock is priced for a beat and a raise. Before every earnings trade, check the expected move. That number tells you what the options market already priced in. So your job is to decide whether reality will be bigger, smaller, or directional relative to that number. So if you have a volatility thesis, use a straddle. If you have a directional thesis, use a spread. If you think the event is overhyped, maybe use a condor. And if you don't really need to worry about defined risk, naked strangles, selling puts, that is also a very good option. Gives you a lot more flexibility to roll up or out in time if need be. Guys, above all else, respect the implied volatility. Remember, that was one of the first metrics we looked at when we were looking at putting on the naked strangle trade that we just walked through. Because around earnings, the option can be, it can be right and still not pay you if the move is not big enough. And if you're buying a call or buying a put and the implied volatility is very high and all of a sudden volatility shrinks, you could get the move you want and still not make money on your option. So Broadcom gave a lot of traders an expensive lesson here. But if you understand what happened, you don't have to pay for it the next time. Guys, we're not predicting every single move. We are playing the statistics, right? We are playing the edges and we are collecting premium. We need to understand what the market already expects, okay? And knowing which structure actually matches the thesis. Guys, this is Luke with the Option Bomb. Make sure you hit like, hit subscribe. I hope you found value in this video, and we'll see you in the next one.